What if I told you that the global financial order you've trusted your entire life is quietly shifting beneath your feet right now, and most Americans have no idea it's happening? Over the past few months, headlines have exploded with talk of de-dollarization, gold-backed trade, and a surprising twist. Reports that nearly 50 nations are reassessing their economic exposure to China at the exact same time. Questions about the future of the US dollar are heating up. If you think this doesn't affect your savings account, your retirement fund, your mortgage rate, or the price you pay at the grocery store, stay with me, because what's unfolding could shape the next decade of American financial power. And if you care about protecting your wealth in uncertain times, subscribe now to Metal Media Insight so you don't miss what the mainstream media often ignores. Let's start with the core fear that's driving so much of this conversation. Dollar collapse. The US dollar has been the world's reserve currency since the end of World War II, cemented under the Bretton Woods system, and reinforced after President Richard Nixon ended the gold convertibility of the dollar in 1971. Even after the gold window closed, the dollar didn't collapse. Instead, it grew stronger because global oil trade and international commerce continued to be priced in dollars. This created what many call the petrodollar system, tying global energy demand to U.S. currency. For decades, this gave America enormous leverage, lower borrowing costs, powerful sanctions tools, and unmatched global influence. But fast forward to today, and cracks are appearing. Rising U.S. debt levels, persistent inflation fears after the 2020-2022 stimulus era, aggressive rate hikes by the Federal Reserve, and increasing geopolitical fragmentation have pushed many countries to explore alternatives, not necessarily to destroy the dollar overnight, but to reduce dependence on it. That's a critical distinction. De-dollarization is often misunderstood as an instant collapse scenario. In reality, it's more like slow erosion, a gradual diversification of reserves, trade agreements in local currencies, and central banks adding gold at record pace. Now here's where China enters the picture. China has spent years promoting the yuan for cross-border trade, launching digital currency pilots and building financial infrastructure outside Western-controlled systems. Initiatives connected to organizations like the BRICS have discussed increasing trade settlement in local currencies, and in some cases, even floated the idea of commodity-linked trade frameworks. At the same time, China's economic slowdown, property sector stress, demographic challenges, and rising tensions with Western economies have made dozens of countries rethink their supply chain exposure. Reports of around 50 nations reassessing their trade dependencies with China reflect not a coordinated attack, but a defensive recalibration. Countries want flexibility. They want options. For American viewers, the big question is simple. Does this threaten the dollar's dominance? The honest answer is complex. The dollar still accounts for the majority of global foreign exchange reserves. It dominates global trade invoicing. U.S. Treasury markets remain the deepest and most liquid in the world. When crisis hits, global capital still tends to rush into dollars, not away from them. We saw that during the pandemic shock, during regional banking stress, and during geopolitical flare-ups. That safe haven status is not easily replaced. However, what's different now is the steady accumulation of gold by central banks. Countries from Asia to the Middle East have been increasing gold reserves at the fastest pace in decades. Gold is nobody's liability. It doesn't depend on another nation's fiscal discipline. And when trust in paper systems wavers, gold tends to rise in strategic importance. That's why conversations about a gold standard are resurfacing. Not necessarily a full return to a 19th century system, but hybrid frameworks where commodities or gold play a stronger stabilizing role in trade settlements. And let's talk about silver for a moment, because it's often overshadowed by gold in these discussions. Silver is both a monetary metal and an industrial metal. It plays a key role in solar panels, electronics, medical applications, and advanced manufacturing. If geopolitical fragmentation accelerates reshoring in the United States, demand for domestic manufacturing inputs could increase. At the same time, if investors start rotating into hard assets as a hedge against currency debasement, silver could experience dual pressure from industrial demand and investment demand. That combination has historically created powerful price volatility. But before we jump to dramatic conclusions, let's bring this back to fundamentals. For the dollar to truly collapse, several things would likely need to happen simultaneously. A severe loss of confidence in U.S. Treasury markets, runaway inflation that policymakers fail to contain, and a credible alternative currency system that is more stable, more transparent, and backed by deeper capital markets. Right now, no single nation offers all three. China's capital controls limit global trust. The Eurozone has structural fragmentation. Emerging markets lack scale. That's why, despite all the headlines, the dollar remains resilient. So what does it mean when 50 nations reportedly turn on China? It signals diversification. It signals strategic hedging. It signals a world that is no longer comfortable being overly dependent on any single power, whether that's Washington or Beijing. Supply chains are shifting toward Mexico, Vietnam, India, and even reshoring back to U.S. soil. This multipolar adjustment doesn't automatically dethrone the dollar, but it does reshape global trade patterns, and reshaped trade patterns can gradually reshape currency flows. For everyday Americans, the real risk isn't an overnight dollar apocalypse. It's gradual purchasing power erosion. It's higher long-term borrowing costs if foreign demand for treasuries weakens. It's more volatile commodity prices if global trade fragments into competing blocks. That's why understanding de-dollarization isn't about fear. It's about preparation. It's about recognizing that fiscal discipline, monetary policy credibility, and geopolitical stability matter deeply for maintaining reserve currency status. Here's something many people overlook. Trust is the foundation of currency dominance. The dollar's strength isn't just economic, it's legal, it's institutional. It's built on transparent capital markets, enforceable contracts, and a relatively stable political system compared to many alternatives. If America maintains that institutional edge, the dollar can remain dominant even in a more fragmented world. But if fiscal deficits spiral without credible reform, confidence can erode over time, slowly at first, then suddenly. This is where gold and silver re-enter the conversation as insurance assets. Not because the dollar dies tomorrow, but because diversification has always been a rational strategy. Central banks are doing it. Sovereign wealth funds are doing it. Large institutional investors are exploring commodity exposure. The average American investor is starting to ask similar questions. How much exposure should I have to tangible assets in an era of rising debt and geopolitical tension? That's not a fringe question anymore. It's mainstream. Now I want to hear from you. Do you believe the dollar's dominance is truly at risk in the next decade? Or do you see this as media exaggeration? Drop your opinion in the comments, because the smartest discussions happen when informed viewers challenge each other respectfully. And if you think more Americans need to understand what's happening behind these headlines, share this video with someone who follows markets but hasn't connected these dots yet. As we move deeper into 2026, watch 3 key signals: central bank gold purchases, the percentage of global trade settled outside the dollar, and foreign demand at U.S. Treasury auctions. Those indicators tell a more accurate story than viral social media claims. Fear spreads fast. Data moves slower, but it's more reliable. At Metal Media Insight, our goal isn't to predict chaos. It's to decode the signals early so you can think clearly while others panic. The dollar hasn't collapsed. 50 nations reassessing China doesn't mean an anti-American alliance has formed overnight, but the global financial chessboard is absolutely shifting. Power is becoming more distributed. Trade corridors are evolving, and strategic commodities like gold and silver are quietly reclaiming relevance in national balance sheets. The biggest mistake investors make is assuming tomorrow will look exactly like yesterday. The second biggest mistake is assuming change happens all at once. In reality, structural shifts build pressure gradually. Then one catalyst event makes everyone notice what had been forming for years. Whether that catalyst ever arrives depends largely on policy decisions in Washington, economic reforms abroad, and the resilience of global institutions. So stay alert, stay diversified, and most importantly, stay informed. Because in a world where narratives move markets as much as fundamentals, clarity is power. And the real question isn't whether the dollar collapses tomorrow. It's whether America adapts fast enough to maintain the trust that made the dollar dominant in the first place. Keep watching, keep questioning, and I'll see you in the next deep dive right here on Metal Media Insight.